Hi. Hi, everyone. Thank you so much for having me today, and I'm excited to get started. Before I can tell you where I've gotten to, I want to tell you a little bit about me. So, for those of you who don't know who I am, my name is Joy, and I have built two startups. One in Silicon Valley, which I exited in a merger and acquisition, and another one in the Middle East called fetchr, which was a logistics company, which I exited 3 years ago. I've raised over $100 million in venture capital. So I'm really proud of that, especially with the new statistics that are coming out with women founders getting less than 2%. The numbers are dropping, they're not going up. So that's extremely frustrating for me. I've been on the cover of Forbes, really proud of that, and super proud of the fact that my face is on the map of the top female founders of the world. And actually, I'm disappointed because I want to be knocked off that map. I want the next generation of women to come forward and raise more than $100 million. So I'm really out there helping women founders, especially it's a soft spot for me. So I'm here today to talk to all you founders out there about how to raise money. That is the job usually of the founders, but really the job of the CEO. Raising money is something that you never stop doing. So it's really interesting when you're a startup. You have to continually raise money. So you got to build the company, hire the best talent, fight the competition, figure out the governance, the bureaucracy, set up costs. And at the same time, you got to be out there constantly pitching for money because startups are usually not profitable. So you have no choice but to actually raise money while you're trying to get to profitability. So it's a challenge. It's not easy. And a lot of things that I have noticed, which I want to talk about today, is that a lot of people are like, I'm a startup. Like the ecosystem of startups is become like such a catchphrase. Everybody's like, well, I'm an entrepreneur. But I think what I want to talk about today is, are you an entrepreneur? Are you? Or are you a small to medium-sized business? Are you an SME? So what makes you a startup company that can be a venture-backed exiting kind of company? What makes you that company? That's the question that I want to ask today. And that's the question that you really have to ask, because a lot of you are out there raising money, but you're not a venture-backed business. You're a small to medium-sized business that is not venture-backed, and VCs are not going to give you money because you don't have a clear type of business strategy that is going to lead to an exit. And let me explain what that means. Venture capitalists are guys who raise money from investors. And what they do is they raise money to make money for their investors. So they look for startups just like you out there to invest in, because they need to return money to their investors within 3 to 5 years. So they look at you as a great company, a great founder, but really in the back of their mind, that's not what they're thinking. In the back of their mind, like, are you going to make me money from my investors, which are called limited partners? They are held accountable. Because just like you, they're out there pitching for money as well to raise money to give to startups. So they're accountable. Don't think that they're, the gods. Venture capitalists are the gods of giving you money. They're not. They're held accountable to their investors, these limited partners. And they are out there looking for companies that are going to have exits. So in the Middle East, their exits are only two things. You either get acquired or you have an IPO. Now, having an IPO is very hard in the Middle East. It's not something that's a regular thing. It's not like in the United States where the market cap is huge and people IPO every day. So the most probable thing is going to be an acquisition. So the question that I ask you guys out there when you're out there fundraising is, are you the kind of business that's going to be acquired in 3 to 5 years? Is somebody going to be out there and to buy you? Because that's where the venture capitalists look to invest. They look in companies that are going to be acquired. So that's something you really have to ask. And when I talk to a lot of founders, I'm like, great business idea. Is someone going to buy you in 3 to 5 years? And they're like, well, I really haven't thought about that. Well, that's something the investors do think about, because that's how they make their money. So if you're a small and medium-sized business, like I've had some companies come to me and they're like, well, I make gluten-free products. And that's a great business to have. And it's a profitable business. But is it a venture-backed business? Can you scale? Can you go from country to country? Are you going to have somebody look at your business and say, wow, these guys are profitable, now we're going to buy them? So these are the kind of things that you have to really look at when you're going out there and fundraising. You can fundraise as a small and medium-sized business, or you can fundraise as a venture-backed business. Two very different propositions. Now, after you come to the conclusion that you're a venture-backed business, then you go out and you raise money. Now, the interesting thing is that I've spoken to over 200 startups, and they really don't understand what it means and how to structure raising money. When you're a startup and you have an idea, your idea has absolutely no value. It's just an idea. It's a thought up piece of paper that's on the top of your mind. So you can't really put a value on an idea. You have to raise what we call a safe. And a safe is basically money that is raised for a discount when you do get a valuation on your company. And one of the biggest mistakes I see for startups is that you give equity for money. You never give straight out equity for money in the beginning. You work a safe note. And for those of you who don't know what a safe note is, take a look and read up about it. It's something that Y Combinator invented to make fundraising easy for the startup community. So this is something that you really have to understand. Every time you raise money, you give away a piece of your company. So it's really important to understand the cap table. It's really important to understand how to raise money. Because just remember, every time you do a round of funding, you're going to lose anywhere from 20 to 25%, even sometimes 30% of your company. If you're somebody who's raised money for equity and you've given equity away, it's going to be very hard to raise money from the venture capitalists, because they're going to look at you and say, you already gave away a big portion of your company. There's no upside in there for me. So you really need to understand from the beginning how to structure a cap table and how to raise money appropriately. Now, if you're in the situation that you've got a great business, raising money, there's no magic to it. Honestly, raising money is about pounding down doors. And everyone is going to tell you, well, what does that mean? Well, it means that you need to take out your Rolodex and you need to pitch every single venture capitalist that you know. And usually you do this by who you know. You know, the Middle East is a very small community. All the venture capitalists know each other. So if you ask for an introduction to another venture capitalist, they will do that. They will help you. And if you're getting funding from one venture capitalist, you can use that to leverage and say, well, so-and-so gave me money. You know, here in Silicon Valley, where I am now today, we have a terminology called FOMO, and I love FOMO. Raising money is like a game of poker. It really is. A lot of these startups are raising money from venture capitalists, and every startup thinks that every venture capitalist is a genius. They know your business inside out. But there are so many different businesses. Not all venture capitalists know every single category. There's no way that you know about fintech, health tech, ed tech. You're not an expert as a venture capitalist in every single segment. So what you need to do as an entrepreneur is find out who's invested in your space. If you're in health tech, do your research and see what other companies have invested, what other VCs have invested in your space, and then go and speak to them, because then they have an understanding of your space. Don't go to a venture capitalist who only invests in fintech if you're a health tech, because you're going to spend most of your pitch explaining your business model and they don't really understand it. So do your homework and invest with the right VCs. If you're lucky enough to get money, taking a venture capitalist is usually somebody who's going to have a board seat. And I want to tell you a very valuable lesson that I learned. And I say this to everybody. As a CEO, you don't control the company. As a founder, you don't control the company. So the most powerful advice I can give you is he who controls the board controls the company. So when you raise money from these venture capitalists, they usually get a board seat. What does that mean? It means they control your company. It means that you better make sure that who you have on your board of directors are on your side, are people who understand your business, are people who have good reputations. Do your homework. Just don't take any money. Take smart money. Take money from venture capitalists who are going to give you value, who are going to say, let me help you. Now, most venture capitalists will say, we're going to help you. We're going to open doors. That's not true. It's up to you as a founder to go to the venture capitalist and say, hey, I see that you support A, B, C, D, E, F. These are the customers that we want. Would you mind making an introduction for me? Would you mind, having a cup of coffee or inviting them for a cup of coffee and introducing me? You have to push the VCs to open doors for you. They're not going to do it because they have tons of people that they invested in. They don't have the time to help you build your company. It's not your company. You have to go to them by doing your homework and understanding who do they have in their Rolodex to help you open doors. But it's really important, and these are lessons learned, that you actually have investors that are really good people who understand, who want to help you, that are not just like, hey, where are the profits? Where are the profits? If you don't have profits, then they're out. You want investment from venture capitalists who are going to be with you in the long run, who are going to reinvest in your space, who are going to be there with you for the long haul. It's like a marriage. It really is. It's like a marriage. You just can't go and marry the first person that comes into your life. You have to make sure that this is really somebody who has the same mindset as you. And for those of you out there who are running around like, I just want to raise money, I think you need to do some real understanding of your business model. You have to really look at the fact, are you solving a problem? What is the problem that you're trying to solve? What is the competition that's out there, right? You need to tell a story when you're raising money. Raising money is about storytelling, especially in the early stages, because there's no numbers to go on. So you really have to have a story of what you have in mind, where you want to go, the exit. You have to say, I'm in this space, and so in the United States exited in 5 years. So had a similar vision, and they had an exit. You really have to tell the story to the investor so they see the same vision that you do. And a lot of the mistakes I see with founders is that they don't tell the story. They get up there, they don't have the passion. You're selling. When you're raising money, you are a salesperson, period. You are selling your dream. You are selling the vision. You have to be a good salesperson. You have to be excited about what you're doing. You have to come in there like you have a cure for cancer. And your passion and your determination in pitching 9 times out of 10 is going to get you the money based on you as a founder. There's no secret, steps, but you need to also not come forward with valuations. A lot of startups are like, oh, I value my company at, $50 million. It's not up to you to value your company. It's up to the VCs to put a value on your company. But this is on later stages of funding. In the beginning, it's all done on a safe note because it's just an idea. So these are really little tricks, that you, not even tricks, but things that you have to do. A lot of people just think they pass a deck and that's going to get you money. Do you know how many decks investors? I invest all the time in early stage founders. I get a pile of desks. If you don't tell me your value proposition in the first 2 slides, I'm out. I'm completely out. They don't have time to go through the 6,000 and all your predictions of I'm going to do this and I'm going to do that. Predictions mean nothing. Like, calculating things that you're going to do in the next, I'm going to do $100 million in revenue over the next 6 years. These are all fluff. You need to articulate extremely clearly in the first 2 pages of that deck exactly what your value proposition is. Because if you don't, then the investors are just going to be like, I can't, I don't have time to go. Can you imagine if you get 100 decks? Okay. Make sure your deck looks sexy. I say the word sexy because a lot of people put together all these numbers. The numbers are noise. The VCs in early stage are going to look at your numbers at later stages. Of course, they want to see it, but in the beginning, they need to understand what your business model is doing. So what I see with a lot of decks is so much noise. It's so noisy that you're missing the basic principle, which is what do you do? Where are you going? Who is your team? So these are little tips that I say. Make sure the visuals on your deck are good, and make sure that you get your value proposition across immediately. So these are some of the things that I talk about. But I really want to answer some of your questions because I have been through the roller coaster of raising this $100 million. Is not easy. So I don't want anyone to think that it's easy raising money. I also suggest that you look outside the region for raising money. It's good to get local VCs, but it's still such a new ecosystem and it's growing. I think it's really helpful to look outside the region as well. And how do you do that? Very simple. Take out your Rolodex, look on LinkedIn. What do you got? How, I'm raising money. You have to tell everyone what you're doing and what your vision is. And another trick I want to tell you with venture capitalists is, getting people to sign 50 NDAs is a turnoff to the VCs because all the patents and the NDAs don't mean anything. It's all about execution. Execute. So I hope that was helpful, but I'm going to take this back to Asad and see if we can get some questions to answer any of your questions out there.
Thank you very much for that, Joy. I really thought it was very engaging, and especially the bits about how the whole fundraising process, you have to get rid of the rose-tinted glasses to go about it, and how people do tend to get a bit mad over the metrics, but it's nice to also have the other stuff to compensate for it. So amazing. So let's jump into some of the questions here. And I think an interesting one is one you ended your talk on about raising money from VCs abroad.
Yeah.
To that effect, how different would you say is the experience in dealing with Middle Eastern VCs versus those based in, say, perhaps Silicon Valley or other countries?
So the VCs in Silicon Valley are tougher. No question about that. They really understand their business model. They've been around for, a lot longer than the VCs in the Middle East, and they understand the exits. So you really, if, I always say this, you don't have to come up with a genius idea if you want to come to the Middle East. You just have to come up with an idea that's already been done and do it better. Kind of like what Kareem did, right? Kareem beat Uber its own game by coming into the Middle East and doing a better job. And then they had to acquire them because they just had market share. So sometimes grabbing market share on an idea that has already been done in the United States, bringing it to the Middle East and localizing it where you grab more market share makes you a great acquisition for the United States when they're trying to do, expansion into other regions. But it's definitely tougher to raise money here. You need to, as I said in the beginning, you need to make sure that you think about acquisition. A lot of startups don't think about that. But like I said very early in the beginning, these VCs want exits. Their jobs and their funds depend on exits. So you really have to have a company that in 3 to 5 years is going to be acquired or IPO. I'm sorry to be that blunt about it, but that's the difference between a venture-backed business and an SME. So an exit. If you want international, you got to really focus on some sort of exit.
Exits are king. We got it. Another one that ties into something you raised earlier in the talk, you were mentioning how a lot of people fall into the trap of giving way too much equity. So are there any steps that they can take or try and avoid this, in your opinion?
You can't give away equity because you're basically going to cripple yourself for the next round of funding. If you give away, I had a startup that came to me and he's like, well, I raised $1 million. I'm like, congratulations. And he's like, I gave away 40% equity of my company. And I literally, put my pen down and I go, well, I'm out. I go, nobody's going to give you money. You gave away 40% of your company. And what he had to do actually was collapse the entire company and start again. You cannot give equity away on an idea. You have to raise money on a safe note. And again, what is a safe note? It's the basic and fundamental thing you do when you're raising money from in the venture capital world. Safe note is that you give somebody, I have an idea. It's a great idea. I love it, but it has no value. It's just an idea. You haven't made any money. It's still very new. So I give you $100,000 and I will get a 20% discount at a future round on a cap. So this is how it's done because it's the highest risk, but it has to be done on a safe note. Please don't give away equity for your company. You do that and you cripple yourself.
That's a very great one to know as well, for sure. And we go back to some of the points we were talking about other markets beyond the Middle East as well. So one that keeps coming to mind recently is Pakistan. It's been creating quite a buzz. It had a record amount of funding last year. I think it was something to the tune of $350 million. And it's obviously got quite a big population, 220 million or thereabouts. What's your stance on it as a space for the startups?
Population. Everybody jumps to the Middle East, but you have to understand something. You need numbers for growth. When you're in the Middle East and you do a startup, people usually start up in Dubai and then they expand to Saudi because Saudi has, I think, 36 million people. Pakistan has, I don't know how many people live in Pakistan, but it has huge potential. A is because it's untapped. B, because of the population. So it's a great untapped area with a large population, which gives you an opportunity for growth. Where if you start off in Dubai and Bahrain and Kuwait and Qatar, they're such small populations that in order for you to get to mass, you need to cover 6 countries to get to the mass that you get in one Pakistan. So I can see why Pakistan is booming. And I think there's a lot of opportunity there. There's so much growth potential in an area that's untapped with huge population.
Amazing. And I'm sure we'll continue to see it in the years to come, given that it keeps going upwards on that trajectory. I think we have a couple of more minutes to go over some more questions that are coming through. So if we go back to the pitch deck and we were talking about how it shouldn't all be about the numbers, there should also be, the side where it's visual and it's appealing in that perspective. So what would you say are the most important considerations when preparing that pitch deck then, sans the numbers?
Tell a story in 8 to 10 pages. Make it graphic, make it fun, make it colorful, make it engaging. Nobody wants to open up a deck and see, 50,000 graphs. It's like, again, the graphs are all just, what I call wishes about projections. Projections are just, wishes. about what you believe is going to happen. I mean, VCs, again, they're busy people. They don't have time to look at every single graph that you put up. So my best advice is to make it colorful, make it vibrant, make it, hire somebody. If you're not good at creating a deck, hire someone to create a deck to make it visually engaging and to get your point across in the first 2 pages. This is what I do immediately. I've looked at over 200 decks, and sometimes I finish the deck and I'm like, I have no clue what you do. And I see that happen quite a bit. You can't go through an entire deck and be like, I still don't understand what your value proposition is. And you shouldn't have to have, 45 pages. A lot of mistakes I see with these decks is like, really? 20 to 40 pages? Quick, guys, quick, to the point, and visually appealing.
I guess that's even more paramount in this day and age where attention spans are already wavering. There's a million and one things to do. So if you can't get the attention, it's just impossible to carry on then. Awesome. Yep. I think we've got time for just one last one from you. And it'd be great to hear your thoughts on this. So going back to VCs, how is it possible to balance the expectations of a VC and the founder's vision for what they have for their startup?
Well, it's about relationships. You got to keep your board members super close. This is very important. Actually, I'm glad we're concluding this. You want your board to be on your side. So you literally, other than the once a month board meeting or whenever the board meetings are every quarter, you really have to make sure that you bring your board members on your side. Create a flow of information where you keep them posted. Hey, we just closed this account. We're excited. I just want to keep you in the loop. It's basically about bringing them in a way of not like telling them every single detail, but letting them know that they are valued and that you are keeping them in touch with what's happening with your company because they're investors. They love that, right? I'm not talking about, I need to schedule a call every week. I'm just talking about keeping them in touch, which like, once in a while being like, can we grab a cup of coffee? I want to tell you where the company's going. I want to tell you, where we're at, or a little email, just sending them out. You've got to keep your investors engaged in what you're doing. They stay on your side. And then in the next round of funding, they're more apt to support you because you're the kind of entrepreneur that is a game player. They want to make sure that you're somebody who is somebody that is easy to work with, that they can talk to you. And if they have ideas, they're going to come to you and say, well, we have this idea. And you want to be like, well, that's interesting. You want to keep them engaged. It's important.
Great words right there, and awesome advice for everybody out there. Thank you so much for this, Joy. It's been a pleasure hosting you, and thank you specifically because you tuned in from very early in the morning where you're based out of. So it's
I think it's 2 a.m. now, 2 a.m. in California, in Silicon Valley, 2 a.m. out here in the Bay Area. So,
This has been absolutely fantastic, and thank you for the time. It has been an absolute pleasure to listen to all the advice that you have to share.
Thank you. I just want to leave your viewers with one thing. Rejection is a big part of fundraising. And if you're somebody that has thin skin and the door slams in your face, then you've got no business being a startup, because just remember that you'll have 1,000 doors slammed in your face, but one day you'll wake up and that one person will invest in you, and it'll be all worth the while. So relentlessness, no fear of rejection, and no shame. And those are the 3 things that every founder needs to fundraise.
Amazing stuff. Thank you so much, Joy. It's been great. And hopefully, I'm sure you'll have a lot of people chasing you for some questions and to get more insights on you. And I'm sure the LinkedIn section is probably blowing up right about now.
Well, so, I'm always glad to give my true Hollywood experience. But there's a lot of pitfalls in fundraising, everything from cap tables to exit strategies, to convertible notes, to bridge financing. There's a lot. So glad to answer any questions that anybody has on fundraising.
Awesome.
Thank you so much for having me, Asad. Thank you.
It was a pleasure.